Hello ladies and gentlemen, welcome back to another episode on this public investment playlist series. If you follow this channel for quite some time, you know the drill. Each month I publicly disclaim what I'm investing on this public investment portfolio, and as always, this is not an investment advice. I do me, you do you. Everyone has a different risk profile. We are all in different life situations. So just because you see here a random guy on YouTube doesn't necessarily mean the things that I'm doing are the best ones for you. There's always risk. Always invest money that you can afford to lose. Having that said, let's jump into the episode. If you know me, you know that I'm always fighting against the time. I'm trying to keep this series as consistent as possible. We've been doing this since 2022 and we're keeping it strong. This week, this past week, not this one, the one before, has been definitely interesting. And for all my friends and family that follow this channel, I know that your portfolio is hurting. Mine is hurting as well. We're opening the Trading 212 app, and from previous episodes, you cannot see this figure is incorrect. Trading 212 is always showing the displays, but this is the correct amount of the portfolio. So right now we have 4,855 euros, and out of which 344 are profits. So if I were to sell all of my stocks right now from this portfolio, I would still have a profit of 7%, 7.6%, but this is nothing. This pales into comparison with the previous episode, or 2 episodes back, 3 episodes back, where the return was over 30%. This is finally a good opportunity for me to be a bit more aggressive into investing into the market. If you watch from the previous years, you know, back then I used to have the shiny stocks really hurting my portfolio and figure it out. Today now are the ones that are more positive. My S&P 500 ETF, it's positive but barely. Then the information technology one, the first one, the QDVE, which is the bulk of this portfolio, 24%. Then the normal S&P 500, only 10% up. The FTS All World, the VWCE, is actually, it was negative when I started this video. Now it's barely positive, but it's at 0%. But this is very cool, and I like to have this kind of time capsule, because when I rewatch previous videos, it's good to see myself, okay, I was at this stage of my life and I thought this was a good decision. Turns out it was horrible, or it turns out it was a great decision. I also see from the background where I was currently living. And you can see here Disney is down, Meta is still up because I really got into a good position back then. Tencent is up, Intel is down. Nike is down a lot, Adobe is down, and you can see here the entirety of portfolio. I even have one company that went bankrupt, which is far-fetched. But without any further ado, you can see here each month I create a different pie where I locate my monthly contribution. So if we scroll back to January of 2022, I started investing 40 euros per month. So if I had invested all my money back then, actually this would be 18%. I would have a return of 18%. So I would be better if I did it. But if I were to invest all my money, let's say in January this year, right now I would be down 17.2%. So my strategy is always very consistent, long-term, dollar cost average. Sometimes I'll invest in market tops, other times I'll invest in market bottoms. When we see some negative downturns, I will contribute more, and as I progress throughout my career, hopefully I'll be able to contribute more to this portfolio. So this is always fun to see, and it's not always good. Open up my camera and here seeing, okay, my decision from the past 4 or 5 months were terrible because I'm losing money, but this always depends on the horizon of time you have. I don't need this money right now. I always am a big defensor, let's say, of having your emergency fund, and then you can invest, and then you spend on your adventures, in your vlogs or whatever you want to do, your trips with your friends, which is important, your family, and then with the money on the side, you direct it towards investments, because if you don't do anything, you're also losing money to inflation, and you're losing purchasing power by the minute. So let's see what is the pie, and you can see that today everything is bleeding. We'll see the pie that I've created for April this month. It's going to be a different one from what I usually do. And you see this average annual return, past performance isn't indicative of future results. This is just a benchmark, but this doesn't necessarily mean that in the next 5 years or 10 years I'll have this return. Could be higher, could be lower, and always an average. You can stay 5 years losing, and then in the last two, you really have unproportional returns, and then it will skew the average. So take this always with a grain of salt. So 20% is going to the all world ETF. This is an ETF that comprises over 3,800 companies, and as you saw before, it was barely at 0%. So this means if I enter right now, I'll be more or less at the same position I've been dollar cost averaging for the past few months. Hence why I'm doing 20%. This is quite conservative. I'm contributing 15% to the classic QDVE. So this is the information technology sector ETF. So it's a more focused one on IT companies. Then 10% on Google, 10% on S&P 500 ETF. So you can see 45% of my monthly contribution is going to ETFs, a bit lower than half of portfolio. But if you see the total bulk of my portfolio, it's still 44 and then plus 8. So it's over 50% easily on ETFs. And this is just my approach. I like to have this basket, this diversity as a support. And then I'll have my individual picks. Of course, sometimes if I had invested all my money, let's say on Meta, when I was convinced on it, I would have a return of 200%. But if I had invested all my money, let's say in Adobe, I would be losing 25%. So everyone needs to do their own risk assessment and see what kind of risk appetite you have. This is for me like a second plan for retirement. So I don't need this right now, and I'm allocating funds how I see them fit. So 20% for the FTS All World ETF. Then the QDVE, Google, S&P 500, then Adobe because it's being hammered down, Alibaba, JD.com, the Chinese stocks that I want to have exposure, and Pinduoduo down there, and Taiwan semiconductors. So you have here 20% of a portfolio. It's being allocated to China and Taiwan, and I also have a new purchase, which is KSPI. KZ is a company from Kazakhstan, so that I have exposure. This is just 5%, so that I have some skin in the game, and I'll see the performance of this stock in the future. Then again, this depends on your risk profile. Always do your own analysis. I used to do these videos, very long videos with a discounted free cash flow, Excel template, very boring stuff. Nowadays I don't do them. I don't have much time. I'm barely hanging on one video per month with this series. But if reach out on me through Instagram and we can discuss about it. Then I have Meta Platforms 5%, Nike 5%. It was beaten down, and Walt Disney. So this will be my allocation in percentages, and you can see that in the last month I contributed 350. So the 251 plus the 48 that I already lost. The month before I had contributed 250, the month before 250, so I upped up the scale, while last year I was contributing 150. And as I say, this is going to be an evolving portfolio, so hopefully as I grow older I'll be able to contribute more, or maybe sometimes in the phases of my life I'll not be able to contribute at all. Maybe if I want to buy a house, maybe if I want to get married, maybe if I have kids, maybe if I have some health problem or whatever. Remember, this is something on the side, and I'm here just to remind you, just stay calm, stick to your strategy. Nobody knows how this will turn out in the next couple of months, next couple of years, but all things considered, long term, there's a really good chance that at least we're trying to fight the loss of purchasing power. I feel like this is what my generation nowadays is mostly concerned with. So, as you saw before, we did 300 last month, and as the market goes down, I'll be increasing my contributions. For this one, let me see if I still have some cash available in the platform. It used to be like there, if I remember, cash. So I still have 2,000 here sitting on the sidelines, and I will be investing. So I'll be investing 400 euros, and we'll see from here in the next episode how this will turn out. 20% to Walt Disney, 20 euros to Walt Disney, 20 to Meta Platforms, 40 for Alphabet, and you can see here the rest of the distribution, how these 400 euros are being distributing with the percentages that I showed you before. So we will go, confirm, okay, and not always all the orders will execute. As always, this depends on which stock markets are open at the time of recording this video. I just left work, so I assume some of these will not execute if I got that warning. But the New York Stock Exchange is open right now, so most of them will execute. As you can see, 77% of it has been executed already, and I still have 180 in cash, which hasn't been allocated to the ETFs. I can see here all the others have executed. And right now this will lower the performance of my portfolio. So right now we have 5,200 in assets, same unrealized profit, but now the return has lowered to below 7%, because you don't give any time for this chunk of contribution to really appreciate or depreciate. So thank you all for watching. I'll see you next time, and anything, contact me, message. We are all together in this crash, or maybe by the next time I do an episode we already rebounded to all-time highs. I'm trying to remember the COVID crash. It really rebounded faster than expected, but then in other periods of history, whenever you joke around with tariffs, there tends to be pretty dark consequences. Let's hope for the best, get ready for the worst, and I'll see you next time.